Good evening, Gauchos. Welcome, welcome. I'm Liz Hollahan, Programs Director at Alumni Affairs. On behalf of everybody at UC Santa Barbara alumni, I want to thank you all for joining us this evening for the August edition of Gaucho Academy, presented by American Pacific Mortgage. I'm delighted to introduce Jason Mata, who will be leading tonight's home buying workshop. And without further ado, over to you, Jason.
All right. Thanks, Liz. Appreciate it. Thanks for kicking us off tonight. Thank you, everyone, for joining us for our really our third quarter workshop, and really excited to be able to bring this content to you. This is a very interactive class that we provide 4 times a year for the Gaucho community, and really excited that you spent a little bit of your Wednesday evening with us. This will be an interactive session. So as I move through tonight's content, really encourage you to ask questions of us. So we'll be kind of monitoring any questions you drop in the chat or the Q&A. We'll take those on, try to make this a very, like I said, very engaging and very interactive session for you. A little bit about our organization. So I work for a company called American Pacific Mortgage. We're the 8th largest lender in the country. Our team in particular focuses on homebuyer education. And so we connect with our local communities through our educational platform that you're a part of this evening, just to provide and kind of pour into you value around homeownership. So the goal in tonight's class is that as you're thinking about homeownership, when you decide to kind of take that plunge and make that financial commitment, you have hopefully learned a few things from our class tonight that you can take with you in your journey towards homeownership. And then, of course, we would love to partner with you on that journey as a leading lender for you to help you accomplish your goals. And I'm grateful to say that we've helped a lot of our Gaucho community achieve homeownership all across California and other markets across the country. So a lot of our relationships with our classes, our clients in our classes, start right here. So as you get a few things to kind of take away, you'll learn more tonight about kind of how we get connected for our free consultation service if you're interested in trying to putting together a plan for you around homeownership. So that's what's going to look like tonight. Now, we are going to record tonight's class. We're also going to send out the slideshow from tonight's session. So that'll be out in your emails tomorrow morning, and then you'll find ways to be able to get connected with us after our class. Our talking points look like this. So we're going to spend some time diving into the housing market, talk a little bit about what's going on with interest rates. Liz and I were just actually having a conversation off screen on kind of what's happening in the market, but I want to kind of share back with you what we're seeing on our side of kind of our lens, I guess, if you will, in today's markets. We are going to look at, does buying make sense for me as you're thinking about taking this next step in your financial journey? Does it kind of line up for me, right? We'll also talk about credit and how we can improve our credit to get ready for home buying, different programs available. We'll talk about savings for homeownership, how we make sure we have enough assets on hand to be able to buy, but also look at first-time buyer programs that can help us maybe close the gap for what we have and maybe current assets versus what we need to get to be able to purchase our home. And then we'll talk about the buying process. That'll be to the latter part of tonight's class, which that's always a big question of our clients is, where do I go from here? So I've attended tonight's class. I've taken a few notes. It's kind of got me, or maybe piqued my interest in home buying. So where do I go from here? So I'm going to walk you through the workflow of buying a house. Okay, so that's our plan for tonight. Again, I encourage you to ask questions of us in tonight's class, and we'll make sure that we kind of weave any questions you have in tonight's session. We'll also carve out a little bit of time at the end of our class as well too. So let's go ahead and launch into our class, and then we'll kind of start by talking about, does buying make sense for me? This is going to be one of the biggest financial decisions you decide to make, whether that's this year as a 2026 goal or sometime in the next couple of years. So in a class like this, we hope that you'll learn a few things that will kind of start to spark that conversation with yourself around, do I want to think about buying? And there's a lot of benefits that come to buying, which would include like stability in my housing expense. So I don't have to worry about my rent going up maybe on an annual basis when I decide to renew my lease. A lot of our clients, especially that are buying in today's market, they may be buying at a higher interest rate level, but there will be opportunities for them to refinance their home. So if rates start to come down a little bit, especially if they drop by at least 1%, we want to think about refinancing. And then this is an asset that should grow over time. So as I, look at how much I'm paying on my mortgage, well, those payments that I make every month help to reduce my principal balance, but my home can go up in home value. So the difference between a value of a home and what your balance is called home equity. And for many homeowners across the country, that is their number one asset, maybe aside from like retirement or whatnot. So homeownership can create generational wealth. It can be transformational for families to be able to get that access to homeownership. And that's why one of the reasons we're so passionate about educating our communities on how you can get access to homeownership. And then tax benefits can come along with owning a home, potential tax deductibility of interest, as well as maybe some other tax benefits that you can gain when you do some energy efficient upgrades to your home. So a lot of cool things to think about when it comes to home ownership. And one of the things that maybe gets lost when some clients are considering home ownership is really the tax benefits, but the equity appreciation and how that translates to my current rent budget versus what it looks like in home ownership. So I want to walk you guys through one of our calculators that we take our clients through as part of our consultative process. And it's called the rent versus buying calculator. And it looks at where am I currently at today from a rent perspective? What does the projections look like for me if I decide to purchase a home? And so I'm going to kind of take you guys through this. But by the way, on our site here, we do have some other calculators that you might have some interest in, whether that's affordability. Maybe you're in a current homeowner or know of a current homeowner that's thinking about refinancing. There's the refinancing option, and then just a standard monthly payment calculator. So those are things that we would encourage you to check out. Let's kind of look at this calculator, and we pre-filled in some of the data points just to keep us on track for our conversation tonight. But let's assume that we're going to buy a house for, let's say, $750,000. We are going to have a down payment of 3%, which basically means that we're going to finance $727,500. We put in an average interest rate today, a 30-year fixed mortgage, which most first-time buyers are going to elect a 30-year fixed product. When I'm going to buy my house, and then we're going to talk about this a little bit later, but when I put less than 20% down to buy my home, I'm going to have mortgage insurance. And mortgage insurance is based upon my credit score, my down payment, and then how much I finance. So there's a factor that we use for PMI. And then we have homeowners insurance, which will vary based upon where the property is located, the taxes for my home. And then maybe I'm going to buy in a community that has an HOA or homeowners association dues. We want to build that into our budget. For this scenario, we won't include that. And then this is kind of one of the things that gets lost a little bit in considering home ownership is, where am I at from a tax bracket perspective? Because that's going to translate to potential tax deductibility of interest. How much cost I'm gonna have to pay into my house in terms of maintenance cost. What's it gonna look like when I sell my home one day? And then appreciation of my home. Again, that's what's gonna drive that increased market value. Now that's all in the home ownership column, if you will. On the rental side of things, let's say we're renting for $3,500 a month. Let's say in Ventura, right? Okay, we're paying $3,500 a month. We're gonna look at buying a $750,000 place. We're going to have renter's insurance today as renters. We're also going to expect our rent's probably going to go up a little bit each year we decide to renew our lease. So that's kind of where we're drawing the comparison. Now, when we think about what we're going to have to put out of pocket to buy my house, down payment, closing costs, we're going to have those as investments into our home. Well, how long is it going to take for us to break even on those investments versus me just continuing to pay rent every month? Well, it's about 4 years in our scenario here, side by side, comparing our rent and our buy scenario, which is a good break-even point. We generally want clients to break even in 4 years or less when it comes to considering home ownership. Now, once we get beyond 4 years, now we're going to be all on the positive side. So now we're seeing our home go up in value, we're paying down our balance, and we're reaping those tax benefits. So now you start pushing that number out to maybe 10 years. You can see our gain opportunity of owning a home is $177,000 over 10 years versus continue to just put away rent money into really someone else's pocket because, more than likely if you're renting from a landlord, they're probably using that to pay down their own mortgage, right? So I think that's where we got to take some consideration of home ownership. It's really important to understand that $3,500 rent payment that we're making doesn't translate to a $3,500 mortgage payment just because of what we've outlined here for you tonight. Tax benefits, equity appreciation, all those things are really important when we consider home ownership. Well, our entry point to home ownership is really important. Like, what are home values at? Because that's going to dictate affordability, how much I'm going to have to borrow, what that payment looks like, all of that stuff, right? So this is an analysis of the California housing market, and we're looking at the last 3 years in this slide here. So you can see kind of what's happening with the housing market. This is the roller coaster line is Santa Barbara County. Then you can see LA and Ventura County, and then California in general. So we look at inventory on the market. That's kind of been a big driver as of late. So Average days on market or median days on market is 42 days with the median home price in California at $782,000. We've had some challenges with inventory being available to buyers in all markets across California. That is starting to change a little bit. We're starting to see more sellers starting to come to market with their homes. At the same time, that is giving buyers a better opportunity to negotiate a little bit too, because more opportunities or options on the market. And if we get more buyers engaged into home shopping, well, then we're going to see a little bit better of a competitive climate where buyers can have the opportunity to negotiate down price, maybe potentially concessions of sellers. Right now, believe it or not, about 30 to 40% of all transactions that we have active with our team in California have some type of concession attached to them, meaning the seller is taking a reduction in price, or they're taking some type of concession or giving a credit to the buyer that can count towards their closing costs. So the market is shifting a little bit. How we forecasted 2026 looks a little bit different now just because of just the changes in the world. But, they're still looking at a bit of a reset in the housing market for 2026. With home buying being a little bit more affordable, we thought interest rates would go lower, but unfortunately with the conflict in the Middle East, that's kind of stalled out any projections on interest rates going much lower. But price growth is expected to be modest. We're not going to see really any big jumps in equity appreciation in most markets, stabilization in most, even some slightly declines in other markets. Most of that is kind of outside California. Some of the bigger states that have higher inventory levels like Florida and Texas and Colorado, Georgia, just to name a few, those are seeing a little bit of more of the dip in price. And of course, some really good buy opportunities. We are seeing inventory improving though a little bit, especially in California. So more sellers coming to market. Many of the sellers that are now having to make the, financial decision that they're going to have to trade in that 2.5% mortgage they have to go and buy something else at 6.5 or 6.6 because maybe they've outgrown that particular home. Maybe they want to get their kids into a certain school district. So, we are seeing more sellers coming to market, which is certainly beneficial for us as buyers. I do think, and as I get the question, in fact, I just got this question today, is it a good time to be in the market, right? Or should I get into the market now? I think for buyers that are financially fit and ready to go, I think there can be some opportunities to enter today's market and get a great price on real estate. Everybody wants the lowest rate. Everybody wants the lowest price, right? That perfect storm of home buying, but it's really tough to achieve. And so I think if we can find the right price and create the best budget for our clients, the interest rate, while it might be at elevated levels, there will be opportunities to refinance down the road. And as we look at our housing forecast kind of year over year and doing some kind of projections here, this is kind of what we've seen over the last 7 years. You can see our comparison year over year here. Prices going up a bit from 25 to 26, which is a 2% incline in price. And then you're seeing the change in affordability slightly improving, but we also expected interest rates to go a little bit lower. So, that kind of is a bit of a skewed number. I think as we're looking at interest rates going into the end of this year, hopefully we'll still see interest rates stabilize a little bit. It's been a very roller coaster ride of interest rates just because the Middle East conflict has really kind of created this situation where interest rates are moving based upon what oil prices look like. We get word that there's going to be a peace agreement and then that falls apart. Something else happens, the conflict starts to rise, and then the markets get a little bit shocked by that. And so then we see oil prices rise, we see interest rates start to rise. So it's not a normal market right now. Hopefully we'll see resolution in that conflict. But the two drivers outside of that are moving markets right now would be inflation. So cost of goods, of course, when oil prices are rising, that increases gas prices, which that moves that inflation number, but also payroll or job numbers. And we have some employment numbers coming out this week that could really move the markets. If we were to kind of push this slide out a little bit, this is July 20th data, but if we were to give you some August data, you probably see this go down a little bit here. So rates have kind of, moved a little bit lower. Right now, average rate's about 6.6%. I think as we finish off this year, I don't think we're going to go much lower than that. We may see 6.5%. But it'll be data dependent for the Federal Reserve, but they're going to make moves on interest rate. Kevin Warsh is the new head of the Federal Reserve. We had him speak last week, which can be a market mover. We posted some stuff on our social, just kind of giving some feedback on what we saw in the markets. But It'll be interesting to see how things kind of play out. I think our original forecast was a 6% rate by end of year. I think we're going to be probably somewhere in the 6.5 range. But I think eventually over time we will see interest rates go lower, but I think we have more to be seen with what's going on in our economy here. Now, what makes up an interest rate, I think, is really important because interest rates are not the same for all clients. It's based upon credit score and eligibility for a product. It's about the type of program you're going to select. Some of our clients will look to buy down their interest rate, which is called discount points. Doesn't make a lot of sense in today's market, but you can pay additional funds out of pocket in order to bring down your interest rate. Usually 1% of your loan amount will drop an interest rate about 0.25%. If you decide to shrink the term of your loan from, say, a 30-year fixed mortgage down to a 20-year or 15-year loan, that can also bring down the level of your interest rate. So it just depends on really what your goals around budget look like. We're going to try to help design the right financing options for you as we kind of support you in your journey towards home ownership. Now, one of the questions we get quite often as clients are like shopping around for interest rates and whatnot is to ask the question around what is APR? Well, APR stands for annual percentage rate, and it's a percentage of your closing costs in the first 12 months of your loan. APR includes things like interest rate and points, different fees that are being charged in association with your financing. And so we like to show you like a little bit of a comparison so you can kind of see how APR can impact really ultimately what the outcome looks like of your financing, because especially for those of us that are doing online quotes with lenders, it can be a bit deceptive online. You could see the same interest rate, but the cost structure behind the scenes can be completely different. As we quote interest rates to our clients, we always quote everything with no points because, it doesn't make a lot of sense to buy points because points have a break-even point of about 4 years right now in today's market. Here's a great example of what APR, how it looks and how it can really change in a comparison of different lenders. So let's say we have lender A here that's saying, okay, I'm going to give you a 6.3% rate with a payment of $31.48, and my APR is 6.68. Well, lender B says, hey, guess what? I'm going to give you the same rate of 6.13 and the same monthly payment. But maybe we forgot to ask the question of, well, how much is that going to cost? And so when we look at APR, you can see the APR difference between lender A's at 6.68 because their fees are $35.89 in one-time fees. But then lender B has fees that are over twice as much as the lender above because they are now taking funds or closing costs to drive down that interest rate, which is in turn lifting that APR. So it's really important as a consumer that when you're doing shopping, especially, online lenders and whatnot, they do play the lowest rate game out there. And unless you ask the question, you could get a rate that looks really great on the surface, but when you kind of peel the layers back, you realize it's going to cost me a significant amount of money to achieve that level of interest rate. All right, hopefully that's helpful for you as you're thinking about interest rates. Now, credit plays a really big role in what interest rates look like for you. Now, every product has a minimum credit score to enter in that particular product. And, the scores that we use are all coming from all three major bureaus. It is a housing score. So the three agencies are Equifax, Experian, and TransUnion. We take the middle score of all three bureaus. There are three different risk models. There's the credit card model, which, by the way, shows up in your monitoring services that you use. There's the auto financing model. And then, of course, the housing model that we use for mortgage. So we're going to take the middle score of all three bureaus. Now, if I'm going to apply jointly with my partner, and let's say my middle score is 740, but my partner's middle score is 720. Well, we're going to use the middle score of 720 to evaluate the options for us in our financing, whether that's interest rate or product, or maybe even the cost of mortgage insurance. If I've had some past challenges on my credit, let's say I've had a couple late payments, maybe I missed a student loan payment, whatever the case may be. If it's happened in the most recent 12 to 24 months, that's what's going to really impact my credit score. Now, the further I get away from that event, the more improvement I'm going to see in my credit score. But initially, it's probably going to impact my credit score a little bit more. Now, when we look at any past challenges we've had with credit, this is a matrix that can give you a bit of a guideline of how long that'll stay with you on your report. Again, the most recent 12 to 24 months is where the impact is going to be, but this is how long it'll stay with you on your credit report. So things like credit inquiries, like hard credit inquiries, they'll be with you for 2 years, but really a hard inquiry will impact you in the most recent 6 to 12 months. There are rules around credit inquiries for auto financing and mortgage that basically gives you a 30-day window of time to shop around with as many lenders as you want. And it's the equivalent of one credit inquiry hit to your score. So if I do an inquiry with ABC lender on day one, I have a 30-day window to do my shopping, and that's the equivalent of one credit inquiry impact to my score. Now, we do things with our team a little bit differently as I work with our customers. We actually only do a soft credit inquiry at the pre-approval stage. And the reason why we do that is because, especially when you work with first-time buyers, the cycle time of buying can be a week, it can be a month, it can be several years. And so I want to give you the guidance and design your home buying plan for you properly without impacting your credit score. And so a soft credit check allows us to do that, but not put us on the clock of having to go shop around in 30 days, but just give us the peace of mind that we can see the credit and it's not impacting your credit score. Now, this is what the mortgage score calculation looks like when us as lenders look at your score. And so my hope in this section is that maybe you guys can see an area of opportunity for you in your own credit profile to help lift that credit score. I'm certainly will help you through that too as part of our consultation process. But here's what the FICO score calculation looks like as it relates to mortgage. 15% is going to be how long have I had credit. So the more mature my credit file is, the better my credit score is probably going to be. If I've had credit for a short amount of time, maybe it's 6 or 12 months, I don't have the track record to get that improved credit score. But over time, that credit score will continue to improve. And then how much credit I'm trying to access is the next weighted average. And that's really, am I opening a lot of new accounts, especially in the most recent 6 to 12 months? We talked about hard inquiries. That's where it's going to really impact your score at a 20% weighting. And then amount owed is going to be centered around utilization of credit or revolving a credit that I have outstanding with revolving balances related to my credit limits that I have accessible to me. Now, ideally, we want to keep those revolving balances at 10% or less of my credit limit amount. So that's the goal. That's optimal. Now, if I'm running those balances at higher levels, maybe they're 80% or 90% utilization, I really want to try to get my first step would be to take save my credit card balances of $8,000 on $10,000 in limits, move that to 50% or $5,000. My next step after mastering that level is to get to 30% or $3,000, and then ideally get to $1,000 or less in outstanding balances. Now, one of the tips I like to share with class is that how you manage credit card debt makes a difference. And what I mean by that is if you can try and pay down your credit card debt before the end of a billing cycle, what you're going to do is you're going to be able to bring that balance down before the credit card issuer reports out the information to the credit agencies. And so what that means is if your billing cycle date or your statement date closes on, let's say, the 25th of the month, instead of paying the credit card on the due date, pay it before the 25th, because that's where you're going to be able to kind of head off the reporting out to the agencies before they do share with the three agencies your balance and your utilization, therefore bringing down your utilization, lifting your credit score, especially as you're getting ready to apply for any type of financing. Last section is going to be how I paid my bills, really what my payment history looks like on outstanding debt. Again, if we have any challenges and in the most recent 12 to 24 months, that's really going to impact our credit score. But it depends also the severity of the delinquency. So the late payments go from a 30-day plus delinquency to 60 days to 90 days over, or 90 plus days delinquency. So the bigger my impact in delinquency, so if at that 90-day delinquency mark, it's going to hurt my score much more than it would be if it's a 30-day late, especially if it's an isolated incident as well. Now, one of the accounts that shows up on credit reports for our clients would be student loans. And, there isn't probably one of our students that come to class here that doesn't have student loans. So we want to give you just a quick high level of what student loans look like and how we view that from the lender's perspective. So if you're currently active in forbearance or deferment, that's when it can be a little bit challenging, because then we have to apply a calculation of 1% of your balance as a projected monthly payment to help you qualify for your mortgage. So that's if you're in a forbearance or a deferment. Now, if you're in active repayment, maybe you're in a savings plan right now or a graduated payment plan, whatever the case may be, then we can use that payment right away. So I always try to give some encouragement in this section that just because I have student loans doesn't mean that's going to prevent me from getting access to homeownership. We just need to help understand what that looks like and what you're currently paying, because that gets folded into a calculation called debt to income ratio, which is essentially something that looks at your expenses versus your income. And I'll talk more about that later on in tonight's class. All right. We're going to talk about loan programs, which kind of it's kind of dovetails off of student loan guidelines, because every loan program does have a guideline attached to it. Before we get into loan programs, I just want to take a quick pause for our audience. Any questions so far on some of the material we've covered so far? And you can just drop your questions either in the chat or the Q&A. Either way works good for me. If you don't have any questions, that's okay. We'll just keep things moving along. I just want to make sure that we take a quick pause for that. All right, let's talk about loan programs. I'm going to give you a 10,000-foot view of loan programs. Some of the terminology I know many of you have probably heard about already. So we'll talk about a conventional loan first. That's under Fannie Mae, Freddie Mac. As a first-time buyer, the minimum down payment is 3%, up to a conforming loan limit of $832,750. So that's a conforming loan limit that is set every year by FHFA. That'll come out probably in the next 3 months, I believe. So we'll set a new conforming loan limit, and that'll get put into play right away. Now, if I'm in a high cost of living market, I can go up to a higher loan amount, but my down payment is going to rise from 3% to 5%. High cost of living areas would include, no surprise, a lot of our Southern California markets, some of our Northern California markets in the Bay. If you're not in California, it just depends on what metro area you're in. But a high balance loan limit goes up to 1.249, Again, that minimum down payment is 5%. The next product is an FHA loan. That is a federally insured loan. FHA stands for the Federal Housing Administration. You can see the minimum down payment here and the minimum credit score. The maximum loan amount will vary a bit depending on what county I'm going to buy with FHA. Now, both the FHA and the product just below that, USDA, are both government insured. USDA is a little bit different because that's for clients that want to buy in rural areas. The benefit around that product, it's a zero down payment option. And so you're going to have to buy in, more of your remote areas. As long as you can meet the income limits and the location, that could be a great option for first-time buyers. But it does have a zero down payment option. These products are both government insured. So there are residency requirements around that. So you do have to be a permanent resident of the U.S. to be able to access both of those products. Not the case with conventional loans. So unfortunately, there were some changes made with the residency status for both these products, but conventional still allows non-permanent and permanent resident access to that product line. Jumbo loans are going to be for clients that really want to purchase with a higher level of financing needed. Let's say I'm going out and buying my first house and it's $2 million and I'm putting 20% down. That would be considered what we call as a jumbo loan. It is going to have higher credit score requirements and a little bit of higher asset requirements as well too. And then our VA home loan is for our veterans that are looking to get access to home ownership. There's a zero down payment option for our veterans, lesser credit requirements, a little more flexibility in expenses. And there really is no maximum loan amount for the VA loan product. What's not included on this slide is some other kind of products that we offer as well, like our physician's loan program. That physician's loan program allows as low as a 5% down payment. And the benefit for a physician's loan is that we talked a little bit about student loans. For the physician's loan, student loans do not get counted against the client when it comes to qualifying for their home mortgage. So if you're interested in that or kind of want to learn more about that, just let me know. Some of our clients also are trying to participate in buying multi-unit properties. So multi-unit properties are eligible. It's a minimum down payment of 5% for a conventional loan. It's 3.5% for an FHA loan. So I know some of our clients that I work with across the country are trying to do like a house hack kind of a thing, right? So they can augment their outgoing expenses through the income stream of a rental property. Certainly allowed, just a little bit higher credit or higher qualifying requirements because generally those home prices are a little bit higher, but you can use potentially projected rents to help you qualify. Now, when we put less than 20% down to purchase a home, there's a thing called mortgage insurance. And I want to explain mortgage insurance to you really quickly. Let's first of all talk about what is it, because I think that's a bit of an unknown, if you will, for most. Mortgage insurance essentially protects the lender against default by the buyer. So if we were to have an economic hardship, we couldn't make our payments, mortgage insurance, whether it's a private mortgage insurance or government mortgage insurance, steps in to protect the lender. Now, PMI stands for private mortgage insurance. So there's about 7 to 8 different private mortgage insurance companies that provide this insurance. And then with FHA loans, there's government mortgage insurance, which is called MIP. So on PMI, private mortgage insurance, there's 3 qualifiers that make up the premium. It's going to be the down payment, the credit score of a client, and then how much they decide to finance. One of the benefits of having conventional PMI is that when I have a 20% equity position in my home, 20 to 22% equity position, and I have at least 2 years in that home, I can apply to have the mortgage insurance canceled. Can't do that with FHA, unfortunately. And generally, premiums on conventional PMI are going to be much cheaper than FHA. Here's an example of PMI on a conventional loan. It's about $209 a month if I put 3% down with a financed amount of $700,000. If you've already started doing your home search on some of the more popular sites like Zillow or Redfin, you're going to notice there's calculators there, but generally those inflate the mortgage insurance numbers. So, I'd encourage you to use some of our calculators on our website. Generally gives you a better kind of depiction of what monthly payments look like. FHA, again, a little bit different than conventional because we're going to have 2 factors now to mortgage insurance premium. There's monthly mortgage insurance for the MIP. There's also upfront mortgage insurance. And with FHA loans, there is no cancellation option. So we're going to use FHA as our entry loan product to homeownership. It's probably not going to be the forever loan. Many of our clients are going to select FHA because maybe they have challenges from a credit score perspective. Maybe they just don't have as much in reserves. Maybe their debt to income ratio is a little bit higher. FHA can be a great way of creating a little bit more flexibility in helping clients access homeownership. And you can see the difference. There's a bit of a trade-off. We're going to have that upfront mortgage insurance here and then the monthly mortgage insurance. And we talked about our consultation process earlier, and those are conversations we're going to have in a one-on-one meeting to see really what makes the best sense for you and what product matches up to some of your goals and your objectives around home ownership. Now, as we're looking at qualifying for a mortgage, let's take a kind of a little bit of a pivot and talk about income for mortgage. And so I'm going to share with you some of the documents we need to kind of evaluate in home financing. You can see the list of documents noted here when it comes to verifying income, some of the assets. I use this part of our class to just do some just discussion around income sources because I get a lot of questions from clients of, hey, I've been on the job for X amount of time. Does that work? So let me kind of throw out to the group just a few scenarios. And feel free to ask any questions that you have as maybe your own personal scenario. But one of the things we get questions on about is like, how long do I have to be on the job to be able to purchase my home, whether I'm, new on my job or just graduated, whatever the case may be. So we have to, as a lender, verify 2 years of work and or education history. So you don't have to be on the job for 2 years to be able to purchase a home. We just have to show a combined 2 year of work and or education history. So you may have graduated from UCSB last fall and maybe you just started your new job January 1 and you're only 8 months on the job. Doesn't mean you can't purchase a home. As long as we can put together that 2 years of work history, that can still help you qualify for a mortgage. Here's an example. We had a client that graduated from a different school, actually out in Texas. They were buying a home out in Corpus Christi in Texas. They were graduating in May, but wanted to buy in July, and they're starting their new job in June. Because we were able to verify the education history, we had an accepted offer letter, fully executed offer letter. They were able to close escrow on their home before they even started their new job, basically, because we had all that documentation. So it can be done for sure. Now, if you have variable income sources, let's say you're in a base salary plus bonuses or commissions, or maybe you're in an hourly position with overtime. In that case, we generally want to see a 2 year history because we need to evaluate those variable sources over that 2 years. So generally we'll average that over 24 months to determine how much of that income we can use for qualifying purposes. If I'm self-employed, we do have to show that we've been filing tax returns consistently for my business for 2 years to be able to count that income for qualifying. If I have 2 jobs, let's say I work in multiple fields, if I want to count both sources of income, then I have to make sure that I've been on both jobs simultaneously for 2 years. If I'm in the tech industry and let's say I have RSUs and I've been with my employer for 2 or 3 years, as long as I have at least that 2 year history, the vested shares I have with RSUs or restricted shares can be potentially used to help me qualify for income for my home mortgage. Okay. Last thing I want to just kind of share with back to the group tonight is that if you're in a full-time job, but maybe you have some side income, whether that's driving for Uber or Lyft or DoorDash, whatever you're doing to generate your side income, if for the side income, we want to include that into the qualifying, then we have to show that we've been doing both jobs simultaneously for the last 2 years. All right. And if you have any questions, there's all kinds of different scenarios that we get thrown at us. But that's kind of a general guideline or what we typical scenarios that we see from most of our clients. One other thing I just wanted to highlight, if you do have, let's say, a partner that's contributing to your household, but maybe they're not going to be part of the loan application, we can't count their income unless they're part of the application. Now, you heard me touch on debt to income ratio a little bit earlier, which essentially is expenses versus income. Let me show you how that kind of breaks down. So when we evaluate options for our clients and eligibility, we take a look at current expenses like student loans, personal loans, credit cards, and the projected housing debt, which would include the principal and interest of your loan, property taxes, homeowners insurance, maybe mortgage insurance because we're putting less than 20% down. That all gets folded into expenses, right? And then we compare that versus your pre-tax income that you're making on a monthly basis. So we've provided an example here of what debt to income ratio looks like. This scenario has someone that's going to have a $2,500 mortgage payment. They have $500 in other expenses. So they're going to have $3,000 going out in those monthly expenses, and they're making $8,500 a month. So this tells us that their debt to income ratio is 35.3%. And the rule of thumb in lending is we can't have that number be more than 45 to 50%, depending on what product we're looking at. The optimal or excellent level, I would say, would be less than 36% debt to income ratio. That's kind of where we see clients being in a pretty good level of affordability. We're going to have conversations in our consultation as to what that budget needs to look like to feel affordable. Everybody has different tolerance levels on what they think debt to income ratio feels good for them. You may be in a position where maybe you're not including other income that's in your household, and so you're good with a 45% debt to income ratio. Whereas some other clients or families might say, hey, you know what, I really feel good less than 30%. So it really just depends. But those are conversations we really want to have around affordability. Down payment also plays a role in home ownership. So, how much am I able to put down on my house? Because if I'm buying my home for $700,000 and I can afford to put $21,000 down, or it's $120,000 down, that is going to change how much I borrow and ultimately drive what my monthly payment looks like. Now, there's various acceptable sources for down payment. Cash cannot be used in a home purchase. So we have to verify all of the assets used in a home purchase. Generally speaking, assets have to be verified for 60 days. So we have to have a 60-day seasoning period. Retirement accounts can be used. We would always encourage you to talk to your tax or financial advisor before you utilize those assets. We don't want to, create any type of tax liability or lose market value for you. So we want to make sure that's a smart move for you first. Gift funds can be also used in a home purchase, and that's where a family member is basically transferring you money. Those funds have to be tracked, but family members can help you out in your home buying process as well too. As I look at the clients that we help, throughout the country, everybody has different challenges in reaching home ownership, whether it's credit, employment, savings. I think the number one thing is probably savings in home ownership. And there's some great first-time buyer programs available right here in California that we'll talk about in a minute or so. But I think a great way to start your path towards home ownership is to work on the savings side, if that's one of your areas of opportunity, if you will. So let me give you a quick, simple calculation, which it looks like this. And it, really, after we get a chance to meet, and if we identify savings as an opportunity for you, let's say I'm spending $2,000 a month in rent right now. After going through your consultation, you think, hey, I can afford $3,500 a month based upon my salary. What I would encourage our client to do is, if we're lacking savings today, let's start spending or saving like we are making that mortgage payment of $3,500 a month on the first of the month. And so what that means is I pay my $2,000 in rent each month. I take the additional $1,500 in surplus. I transfer that right to my savings account every month. And as I do that, I start getting that rhythm of, hey, I'm used to making a $3,500 payment because I've been saving like that every month. And I'm seeing my savings grow. At the end of 6 months, I have $9,000. End of the year, I have $18,000. And if I'm putting into a high yield account, getting 3% interest or 4% interest, now I'm starting to make money on that savings as well. So Really simple calculation. I've had plenty of clients that have really used that to their advantage to help them prepare for home ownership. And that can really help close the gap for what we need to achieve to meet our down payment and some of our closing cost goals of home ownership. Now, in California, we have some wonderful resources that are available to us. We're proud to be the leading partner with the California Housing Finance Agency, supporting first-time buyers all across California. There's a variety of different programs that you can get access to. So I want to kind of give you a little bit of a high-level look at some of these products and give you kind of a scenario of how we can implement different products to help maybe make homeownership a little bit more of a closer goal for you. Now, CalHFA specializes in supporting low to moderate income first-time buyers all across California. There's various products that are available, conventional loans, FHA loans, even USDA and VA loans. On a conventional loan, you can get up to 3% of your sales price in assistance to help cover that minimum down payment. FHA loans, you can get up to 3.5% to cover that minimum down payment. And essentially what it is, it's a separate loan that we create for you at a 1% simple interest rate. There's no monthly payments on it. Back payments are all deferred until you either sell the home or if you refinance in the future. Now, some of our clients might need more access to resources. We can tap into things like the My Access program, which is up to 2.5% of our loan amount in additional assistance, which is, again, another 1% simple interest rate loan, closes the gap in terms of what we need out of pocket, and we don't have to pay that back until we either sell the home or refinance in the future. One of the more popular programs that CalHFA launched, and we had a big part in the creation of, which is called Dream for All. You may have heard of some of the advertisements or some of the spots on KTLA and some of the big news outlets, a lot online, right? Dream for All is a shared appreciation program where you can get up to 20% of your sales price in assistance or $150,000. That program is not in circulation right now. You would have had to apply for the lottery earlier this year. We may get another round of funding in the future. I would just make sure you stay connected with us, and we'll certainly update our communities as we learn more about that future offering. But that's a really great product. And then there's other products available too, like the Pathway program, which can provide up to 3.5% to 5% of your sales price in assistance. That only is compatible with an FHA loan. For our low-income housing buyers, we have the 1% program, which basically means if you contribute 1% of your purchase price, APM will match you up to $4,500 or 2%. So it's designed more for our lower cost of living markets and lower income clients, but certainly is a great opportunity. Golden State Finance Authority is another one, the Chenoa Fund, and Fannie Mae and Freddie Mac. For the low income and very low income buyers, there are certain grants that are available out there as well too. I missed this question that came in, so I just want to make sure I just take it on really quick. For the physician housing loans, does that apply to chiropractors and nurse practitioners as well? Yes, I believe that physician loan does apply as well too. Yeah, thanks for that question. And we could talk about, I mean, the physician's loan doesn't always make sense because we can maybe get to the same place with a cheaper product like a conventional loan. So we just need to see if it's really like the student loan component would really benefit you if you're going to take on that product. All right, let me just give you a quick breakdown of how the application of a CalHFA loan would look like as compared to, say, more of a traditional financing structure without first-time buyer benefits. Let's say I'm going to buy a $700,000 home and I'm going to put 3% down, and that would be $21,000 plus I have closing costs. So I probably need on hand about $35,000 to $42,000, give or take. Now, if I use the CalHFA assistance program, I could get access to that My Home Assistance. That's 3% to help offset what I need to put out of pocket for down payment. If I only tapped into that resource, then I only have to worry about my closing costs. But let's say I need more resources, then we can get the My Access program involved. So, you know, for a buyer that meets the qualifications under CalHFA, you can get almost up to $38,000 in assistance. So that's a really, really great options. Now, there are eligibility requirements for CalHFA. You do have to be a first-time buyer. There are minimum credit score requirements that you can see here by product, debt to income ratio maximums that follow the Fannie Mae and FHA guidelines. And one of the interesting things about CalHFA, the income is only based upon applicant income. It's not based upon household income. So you may apply just in your name, but maybe there's another source of income. If they're not included on the application, then their income is not factored into the income limits for the program. And the income limits are set at 150% of the median income. A first-time buyer, as definition by CalHFA, is someone that hasn't owned a home in the last 3 years. and it's eligible on all properties that are one-unit properties. Only caveat down here is manufactured homes. It does have to be on land that's owned. It can't be like in a park. Here's some of the income limits here for CalHFA. These income limits get updated every June, so that's when we'll generally see those updates to income limits. They are, as compared to other products, they're probably one of the highest income limit products that we have for our first-time buyers. Before we talk about what closing costs are, I want to take on one more question, which is for Dream for All, when available, how do you enter the lottery? Also, should they be active again? If there are two borrowers, do both have to have parents who do not own a home, or only one of the borrowers be enough to qualify? So if Dream for All comes back online, and the guidelines stay the same, one of the buyers has to be first generation, meaning that you have not owned a home in the last 7 years and your parents do not currently own a home in the US, or did not, if they've unfortunately passed, they did not own a home at the time of their passing. So that's the uniqueness of the Dream for All program. So at least one of those buyers in a joint application would have to be considered first generation. All buyers have to be considered first time buyers. So that's just the caveat to that program. All right. And we'll certainly keep you updated if that program comes back online. Right now, we're currently working with clients that have received a voucher. And so essentially the way the program works is they'll open up a lottery window. We will pre-approve you for the lottery. The lottery window is usually open for 30 days. You apply to the lottery portal, and then there's an audit period. And then they make selections. And for example, this latest wave of lottery recipients, 2,000 people in California received a voucher to be able to access homeownership. And so it gives them 90 days to go out and use that voucher to go under contract with the seller. Okay. There's more information on our website. I think one of my colleagues can put in our link to our Dream for All website if you want to check out some of our videos that we post on that, as well as some of the guidelines that we have on our website. I want to explain to you closing costs, because when you purchase a home, yes, we have to save for down payment, but there's also closing costs involved with purchasing a home. What are closing costs? Well, they include things like the fees from the lender. They include things like the title and escrow fees that are third-party charges that are part of the transaction. There's things like prepaid items that are involved in a home purchase, the prorated property taxes that you have. You have to pay your homeowner's insurance for the full 12 months when you buy a home. So all those things kind of ultimately fall in the category of closing costs and prepaid items. Closing costs will vary based upon what you negotiate with the seller, the type of property you're going to buy. A condominium home purchase and a single family home purchase could look a little bit different because of HOA expenses. We always tell clients to budget themselves about 2 to 3% of their sales price for those estimated closing costs. But just keep in mind that prepaid items like the homeowner's insurance, prorated taxes, those can change what that total number looks like. When we work with a client at time of pre-approval, we're going to use some general estimates to give you for your closing costs, but that can change. And so once you're under contract with the seller, I'm going to meet with you for a virtual session to go through line by line itemization of every cost involved with your home purchase, so you have a clear understanding of what that looked like, and you have an expectation of what your out-of-pocket expenses look like. How do you lower closing costs? Well, you can negotiate with the seller to take on more of the closing costs. You can say, hey, let's split the escrow fee, or you're going to pay for the owner's title insurance. You can negotiate seller credits. In fact, we had a client that just got their offer accepted in Monterey County, and they got a $13,000 seller credit to go towards those closing costs. And of course, as we learned this evening, you can use various loan programs that include closing cost assistance. So there's ways to cover those expenses as part of your home buying plan. And we can take you through that as part of our consultation. Now, as we get towards the latter part of our class tonight, I do want to walk you guys through the workflow or the home buying process. It really kind of helps you better understand, like, where do we go from here after class? And hopefully you've got a few great takeaways from tonight's class, hopefully some information that you didn't know before you came to tonight's class. And, after we leave, we'd love to be able to get connected with you for our free consultation. That's a 30-minute video session that I do with all of our clients. You don't have to have the expectation that you're going to buy anytime soon. It could be this year or in the next couple of years, but we just want to be a partner with you to help you understand your options in financing. Well, when you decide to take that next step, we do the consultation with you. And as we kind of start this workflow, step one is a pre-approval consultation. So we would meet with you, design your objectives and goals for homeownership, and then we ultimately will issue you a pre-approval. The nice thing about a pre-approval, it's not time sensitive. So you can buy this year, you can buy next year. We just have to recertify it because it's generally good for 60 days, but you don't have to reapply for an application or anything like that. And I always encourage clients, like, it's not a pass or fail type of pre-approval consultation. We're going to be a partner with you in helping design some different options for you and see what makes the most sense for you. So once we've kind of created that baseline for you in eligibility, now we move to step two, what's called house hunting. And so, in the house hunting phase, many of you in class probably have already kind of peeking around online a little bit, but now at step two, you know what you qualify for. And now we want to start kind of looking at homes, maybe online, maybe start going out and looking at some open houses. I would always encourage you to talk to a realtor in your local market. We have a fantastic network of preferred realtors all across the country that I trust in the process because they create the same client experience that we try to do with our team. So if you ever need that connection, we'll certainly make that introduction. Now, I get the question often is like, Jason, how long is it going to take me to buy a house? It really depends. And I think the longest phase in the cycle is probably step two. It could be a 2-week. It could be a 2-year process. You may want to live in that particular community. You want that certain school district, that type of home, that type of lifestyle, whatever it might be. That can change what that cycle time looks like for you. But eventually you're going to find that home, right? And when you do find the home, you're going to work with your realtor to help construct an offer and present that offer to a seller. Now, if the seller accepts your offer, then you're going to move to step three, and that's called entering escrow. That means you have a ratified contract between you, the buyer, and the seller, and you've set some terms and conditions of that offer, timelines of the transaction, kind of action items for yourself. In most transactions in California, they're going to close between 21 to 30 days. That means from the time my offer is accepted to the time I get my keys and start firing up the moving truck, it's about 21 to 30 days. Some markets, it can be a little faster. We have to move a little bit swifter. We have our quick close program where we can close as fast as 14 days. So if you get into a hyper competitive situation, you really want that house, we can really condense our timelines. So let's say if we fast forward a little bit, we got our offer accepted. That day, I'm going to give you a call and say, hey, congratulations, you got your offer accepted. Let's talk a little bit about some next steps. Let's get you on the calendar in the next couple of days to do a follow-up virtual session so we can go through all the design work for you of your financing. Let's talk about your structure of your offer, make sure that you understand kind of what your to-do list looks like, and you'll get a kind of a checklist of items from us. Now, in your contract, you are going to have the responsibility of making what we call is an earnest money deposit. And an earnest money deposit is usually in most markets 1 to 2% of your purchase price. Sometimes it can be 3%. It's held into an escrow account, and it does count towards your total out-of-pocket expense. So it'll go to those closing costs, down payment, prepaid items that you have left on your balance owed for your home purchase. Now, that deposit is usually protected by what we call the contingency period. Unless you decide to waive that contingency, a contingency allows you to do your research on the property, but have that deposit protected in the escrow account. So if something kind of goes off the tracks a little bit, you can still get out of the contract and get your full refund of your deposit. The appraisal contingency, inspection contingency, and loan contingency is anywhere between 7 to usually 17 days. We want to make sure the appraisal comes in at value to support what you're buying the home for. Of course, your inspections, you can choose a whole variety of inspections, home inspection, roof, pool, sewer, whatever you decide that you need to do to make sure that you're making a good sound purchase. And then loan contingency, we just want to make sure we get your loan approved before we remove that contingency. So as we look at this buying process, here's our accepted offer, here's the finish line. So now we're moving down the tracks here. We're going to do the processing, the underwriting of your loan, some of the administrative tasks. By that time, we've already met for your follow-up video session. You're getting disclosures sent to you that highlight everything we reviewed during your follow-up video session. And then we move to step 5, which is your loan approval. That's also going to take us to really the end of the contingency period, more than likely, depending on what that looks like in your specific contract. Once we have loan approval, the appraisal's back, we're really going to be in a good position now. We're going to start kind of fine-tuning everything and deliver to you your final closing disclosure. You do get disclosures through every milestone in the process. Those are all e-signature disclosures. The next phase in the process will be the final. That'll be kind of the finish line. That's closing the loan. That's when you meet with a public notary to sign final loan documents in person. You'll also wire in your final funds at that time, so wherever that's owed, and that should align with what we've talked about in your follow-up virtual session earlier in the process. Those monies get reconciled with the funds coming from your financing, and then documents get recorded with a county recorder's office. They're going to record the transfer of ownership. We call that a grant deed, and then the deed for the mortgage, which is your repayment terms of your loan. And guess what? After that gets all confirmed as recorded, now you're the new homeowner. And that's a huge, huge day of celebration. We've had a couple clients get their keys to their homes today. Actually, one was in Kansas today. We had another one in California earlier. So, that's an exciting day of celebration. And we're right there with you to celebrate. In our relationships with our clients don't end there. Part of our aftercare process is we want to stay connected with you. So after you move in your house, we want to see and hear how you're doing. We're going to provide you tools like our HomeBot system to track your home equity, our rate watch system. We have a dashboard to kind of monitor the rate market. So if it does make sense to refinance, we want to make sure we're here for you. And of course, Delise just checking up with you on an annual basis just to see what's happening, if things have changed for you financially, or how we can basically help serve you as you can continue to become homeowners. Well, if you're thinking about moving forward in the process, I'd love to be able to get connected with you. You've heard me talk about that consultation. We've outlined the steps in the process here. Really simple. It's a really easy online application. You upload documents and then you just schedule your consultation whenever it works for you. And I meet with all of our clients from classes all across the country for one-on-one sessions, and I'll be here to partner with you on this journey. If you have questions after tonight's class and maybe you don't feel comfortable asking them in this environment, feel free to schedule an introductory call. We'll schedule a time to just meet and just kind of go through your scenario, whether it's a credit question, employment scenario, property, product, whatever it might be, just let us know. And this is what our consultation process looks like. So we're going to do a lot of the conversation around what we've discovered tonight in our class, which will include going through budget and where do I want to buy, credit, product, assistance programs, all of that important stuff for you. We do really embrace technology in our process, whether it starts from mobile, some of our AI tools that are used, but it does not replace the human touch in our business, the human element, right? Just staying connected with you. This is going to be the biggest financial decision you make. So we're always connected to our clients, whether that's a quick email or a text message or a phone call, just to make sure that we know that we're here to help support you in this journey. Part of that support, and especially in our UCSB partnership, includes discounting our services, giving you a great priced product, giving you access to, of course, the classes that we do and the various tools and resources that we have available to you. If you've liked tonight's class, we encourage you to share this with your local communities, friends and family, coworkers. We'll have quite a large class schedule still on the docket for 2026. These are free classes open to the public. So if you like the content, feel free to share that with your colleagues and, like I said, friends and family. If you want to just get connected with me, here's all my contact information. And of course, you can book your appointment online here. And follow us on some of our socials. I think we try to put some good content out there on Instagram. This video will be up on our YouTube channel, so feel free to share that out there as well. And we love what just our community says about us, whether that's in a Reddit forums or just on some of our reviews. We really try to take pride in what we do. This isn't just a transaction for us as we partner with you. It's really a relationship that spans over several years with our clients. So thank you so much for joining us tonight for our class. We got some time to take questions. We'll be here for as long as you need. I know I've taken a few questions already, but feel free to drop any questions in the chat or Q&A, and we'll make sure that we answer those for you. And thank you for that. Appreciate that. And again, we've recorded tonight's class too, so we'll send you guys out the recorded version if you had to step away from your computer, and then we'll also provide the slideshow as well too. All right. Okay, well, I think we're good. Well, thank you so much for joining us tonight. Hopefully you felt there was some good value here in spending your Wednesday evenings with us. I know there's other things you probably could be doing, but we appreciate that you decided to join us for the last hour. So thank you again for attending tonight's class. I look forward to seeing you all soon. Have a good night.